Welcome to the Market Roundup with the legend, Martin Pring. This is a very exciting program. I'm so glad you're here. A big thank you to StockCharts.com and IFTA for hosting this event. StockCharts.com, StockCharts TV generously has produced this episode, and IFTA is hosting it. And please go to the International Federation of Technical Analysts to find the local technical analysis society in your region. Check them out, ifta.org. It's a great place to be a member if you are a technical analyst of any degree. And also great events coming up in August, 2 big events, very exciting. They're webinars. You can attend anywhere in the world. And also there's going to be a phenomenal fall conference for IFTA, and it's coming out of Australia, and it hopefully will be streaming. So please check that out. Also, all of that is going to be on the ifta.org website. And with that, the legendary Martin Pring, the father of econometric technical analysis, in my opinion, is with us right now. Hi, Martin.
Hi, Bruce. How are you?
I'm great. So glad you're here. This is a continuation of a presentation that Martin gave at the beginning of the year. This is the Market Roundup mid-year review. And with that, thank you so much, Martin, and we're really excited to hear what you have to say and what you're thinking right now.
Well, thanks very much, Bruce, and thank you very much for that very kind introduction. I'd like to start off by just summarizing some of the main points we're going to be talking about. When we came to do the year ahead presentation at the last December or the beginning of January, my main headline in red was inflation will continue to be a problem for stocks. Now what I've done is I've changed the headline and called it inflation will continue to be a long-term problem for stocks, because in the immediate period, in the next 6 months or so, I see a dissipation of inflation through commodity prices and the CPI. But after that, I think we're going to continue on with more inflation, but more of that later. Number two, the secular trend for US equities is in the balance. There are a number of indicators, as we'll see going through this presentation, which are leaning slightly to the bearish side or not quite there, or right at very, very important levels. And so we're at a very crucial point in a lot of these charts now in terms of the secular trend. Number three, industrial commodities have flashed a cyclical sell, but that cyclical sell has come under the context of a very long-term secular bull. Number four, yields are headed in a similar direction, in other words, an upward direction, but they're also due for a correction before they move higher, I believe. So we're going to be talking a lot about secular trends and their characteristics. So I'm going to just outline a couple of points here, which I want you to bear in mind as I go through the presentation. First, a secular trend is a very long-term trend, generally lasting between 12 and 25 years. And it embraces a number of different business cycles. One of the problems about secular trends is the reversal signals are typically generated, because we're looking at long-term trends. They're generated 2 to 4 years after the final peak or trough. And another problem we have is that because there's such long-term trends, we have limited data points. There aren't many of those data points on which to base conclusions. Secular downtrends in equities specifically are normally associated with excessive inflation, but sometimes you get pockets of deflation like 1929 and 1921. But normally these secular bear markets in stocks are caused by an excess in inflation because they're reflecting structural problems in the economy. Secular trends also dominate. This is the reason why I think we need to focus on the secular trend, especially in stocks. the secular trend dominates the character of the primary trend. So if we have a primary bear market, it's generally going to have much greater magnitude and duration if it appears in a secular downtrend. So with those background points having been made, let's just take a closer look at the relationship between the CPI and commodity prices. First of all, I want to point out to you that a lot of these charts go back before 1900 or back to 1900, and you may not be able to see the dates at the bottom of the charts. If you can't, they're always displayed up in the top legend here, where I just highlighted a rectangle. So this, in the top part of the chart, we have a 12-month rate of change of the CPI. And as you can see, when we talk about inflation, we tend to think of it going up and staying up, which it does in terms of prices. But in terms of momentum, it comes in waves like it did in the 1970, where it peaked around 1969, and it peaked around 1974, and then it peaked around 1980. So when we talk of inflation, we tend to be talking about an expansion over time going in waves. The other thing is that this red line here is at 6%. And when you get above 6%, generally speaking, that tends to be a secular bear market for equities, or part of that secular bear. So when we get above 6%, that in itself is a flash signal that usually you're in a secular bear market for stocks. There was one major exception, and that occurred in 1951 when the inflation rate got up to 9% here, and was not part of a secular bear market in stocks. In fact, it was right at the beginning of the secular bull market that went from 1949 to the mid-1960s. So that's an important thing to understand. The other thing is that we've got two indicators in the bottom window, and they're both price oscillators that divide a 5-year or 60-month moving average by a 30-year or 360-month moving average. So we're measuring very long-term trends here, and they kind of reflect what's going on with the secular trend. The green is commodities, and the blue is the CPI. And what you notice is that the commodity oscillator has a strong tendency to lead the CPI. So if we're watching commodities, we're getting an advance warning of what might happen in the consumer area. And right, as you can see right now, we have a buy signal for the commodities that just turned up. And we also have a buy signal for the CPI as well. Now, what I'm going to do now is to also show you how the commodity secular trends affects the CPI, because I'm going to shade the areas where the commodity oscillator was moving up. And you can see it starts at the bottom out here and then moves up and peaks just here. And you can see what happens to the CPI. All those periods of excessive CPI tend to occur when the commodity oscillator is in a primary bull market. So these are things to bear in mind when we get to look at the relationship between the stock market and its and inflation. So the next chart we're going to show, we're going to start with bonds here, because they've been in a secular bear market since 1981. This chart is from 1997, just part of that range. But one of the important things to note is that this secular downtrend line was penetrated a few months ago, and the indicator, the 20-year yield, also broke above its 96-month moving average. And that was the first time it had broken above the 96-month moving average, except for this time just here back around 2018, 2019. So that was an important signal. But right now it's running into resistance in the form of the 2018 high. So that's one of the reasons I think we're going to see, excuse me, a little bit of a correction. The other important thing on the chart is this 18-month rate of change in the bottom window, because that moved from a record low to a record high. And I always think of rates of change as substitute sentiment indicators. So when you see a swing like of this nature here from a record low to a record high, that's typically the kind of signal that's associated with a reversal in the secular trends. In other words, the momentum is backing up what we see in the trend evidence. The other thing is that high momentum comes as a two-edged sword. On the one hand, it's bullish for rates here, but on the other hand, when you get to an overbought situation, the probabilities favor some sort of a correction. So what I'm looking to see is a correction in an ongoing secular bull market. So maybe it comes down a little bit here, 250, 275, and then bounces and then starts to move higher again in the next cycle. But at this point here, it does look to me as if the secular trend in bond yields is reversed. And that's also consistent, of course, with what's going on in the commodity area, because bonds just hate, bond prices hate commodity prices going up. So now we're going to turn to the stock market. And what I've got here is a lot of ellipses, and they all isolate various bear markets since 1947. And the blue ellipses represent bear markets that are associated with slowdowns or growth recessions. And the reddish pinkish ellipses represent recessions. And you can see that most of the time when the trend of the market is up, the secular trend is up, what we get is small corrections, relatively small corrections. But then the big five are all, what I call the big five here, all associated with deep recessions. So these all occurred during a secular bear market. It doesn't look much like a secular bear here because it started down here and ended up here in 1982 at higher nominal prices. But the whole point of looking at stocks from a long-term perspective and these secular trends is to adjust equity prices for the inflation rate. And that's what we do in the next cycle, in the next chart. Because here you can see that those bear markets are really accentuated because these are periods of relatively heavy inflation, the 1970s. So here's a secular bull market. And you can see the bear markets are relatively contained, either in terms of time or in terms of magnitude. And then I can put the other secular bears and secular bulls in here. And you can see how the secular bears all embrace the big five that we talked about before. And since 2009, we really haven't seen much in the way of a recession, except the 2-month drop in prices. The 2-month drop in the economy that took place in 2020.
So the loss of purchasing power in those big recessions is just incredible. So it's not just the nominal cost of a decline in the stock market, but you have to adjust it for this inflation rate, which has a huge impact.
Yeah, exactly. I mean, you can make 50% in the nominal terms, but if the CPI goes up 50%, you haven't made anything.
Yeah.
So it's very important on these longer term charts to adjust for inflation, because then you get the true picture. So the question then becomes, how do you monitor secular trends? Well, one of the ways, this chart here goes back to 1828, by the way. It's quite a long chart. One way in which you can do this is to use a price oscillator like we use for commodities, the same price, the same time frame, 60 divided by 360. And that when you get a peak in that oscillator, that tends to give you a secular peak in equity prices. There was one exception back in the 1880s where we got a sell signal from this oscillator, and it was followed by a trading range rather than a secular bear market. And again, all these charts I'm showing are going to be adjusted for inflation. All the long-term stock charts are. Right now, it's in a rising mode, so it's not giving any indication of a secular trend reversal. But remember, it doesn't have to do it right away. It could take a couple of years before it starts to turn over. One of the other points about a secular trend, when you reach a peak, is the recapture period is usually pretty long. In this case here, it was 17 years. In these cases here, it was 27, 22, 29, 26. And then recently, just 9 years to recapture the peak that was seen in 2000. So you can say a little bit over 20 years is the average period it takes to recapture those peaks. Another observation is the fact that during the secular bear market, you got all this inflation, generally speaking. And the other thing is you're getting in structural imbalances, and that's reflected in the fact that the secular bear market contains a lot of recessions. There were 1, 2, 3, 4 in this secular bear market here, compared to one recession during the 1982 to 1990 period. And that was in 1990. Sorry, from 82 to 2000, and the recession occurred in 1990. So that's another thing to bear in mind.
So do you tend to get more recessions when the inflation rate is generally rising? And because you can see that definitely in the 70s, which was a period of ever increasing inflation.
Yeah, absolutely.
Mm-hmm.
Not so much before 1900 when there were a lot of recessions, because that was before the advent of the Federal Reserve. And the Federal Reserve since 1913 has given us more inflation but less recession. So it's kind of achieved one goal without achieving the second goal. Another way of looking at secular trends is to consider the Shiller PE. That's a long-term measure of real earnings, and adjusted, it filters out cyclical movements. Most people look at the Shiller PE as a fundamental indicator. I look at it as a sentiment indicator. For example, in 1929, the PE got up to $32, which meant you were spending $32 for each dollar's worth of earnings, which indicated to me that people were extremely optimistic. Whereas in 1932, they were willing to sell stocks for only 6 times earnings because people were so pessimistic about the outcome. So the great thing about the Shiller is it does move in great price swings. So there's a peak in 2000 and 1900. There's another one in 1920, and then we get the low in 1921, and you repeat this up and down swinging action throughout the whole period since 1900. There are 2 aspects to the Shiller which I think are important. First of all, is the level. The higher the level, the greater the optimism, and the greater the optimism, the greater the potential for people making careless decisions, and therefore the more careless, and therefore the more vulnerable stock prices are. And the other is the trend. Now, the important thing is with the level is that if it's at a high level, there's nothing to stop it from going higher. It's kind of like elastic. But when the trend reverses, then that elastic snaps, and you're into a downward movement. So I get rid of these arrows, and then I just put the overstretched level in here, where it reached 32.50 or whatever it was in 1929. And then it reached it again in 2000 or 1999, 2000. And then recently in 2021, it reached it again. And whenever it reaches these levels in the past and reverses, that's indicated as secular bear market in stocks. So let's just take a look at this area over here for the last 15 or 20 years or so, using the same 2 indicators. So here's the Shiller in the lower panel. And first thing I notice when I look at this chart is the fact that it broke above that green resistance trend line, but that turned out to be a false breakout. Now, in my book, false breakouts are very significant because they're usually followed by above average moves in the opposite direction to the breakout. In this case, the opposite move is a downward one. And I also like to make sure that false signals are actually confirmed as well. And that can be with a trend line break or a moving average and what have you. In this case here, it's a trend line break, a decisive one, and it's also below its 96-month moving average. If you notice in the last few years, that 96-month moving average, with the exception of this whipsaw move down here, which is in this case followed by a sharp move to the upside, crossovers have been pretty reliable. So this is just a marginal crossover at this point, but we've definitely violated this uptrend line, which kind of confirms this false upside breakout.
It's as
When
though
we look at
also that,
inflation adjusted,
I'm sorry, I was just going to say that it's as though once you turn from extreme optimism down and the PE ratio starts to drop, it tends to just persist for a while. And as
yeah,
psychology shifts.
well, it's the snapping of the elastic, as I was referring to just now.
Yeah. By the way,
So the other
folks, if you love this work and you love the perspective of it, have a look at Martin's inner market review, which every single month he's profiling the most important charts in these intermarket relationships, just as you're seeing here, pring.com, and go check that out because it's an incredible piece of work. And Martin, I'm sorry, I just had to say that.
Yeah, I guess you did, Bruce. Don't let it happen again. Thank you. So I was going to refer to the inflation adjusted equities in this upper panel, and you can see there's lots of different ways you can draw this trend line, but in this particular instance, it's back to support in terms of this trend line. So we got a market which is very oversold at this point, going into the second half of the year. And if the secular trend is still an upward one, this would represent a great buying opportunity at this point here. But what we're seeing from the evidence on the secular indicators is not so fast. You might want to wait and see and take a view later. One of the other things about this chart is I can draw another trend line, a resistance trend line, joining all these highs here and extend it out. And you can see there's a false break there. So we're seeing false breaks occur all over the place here. And that's always the most dangerous thing, especially when you're just breaking through a long-term resistance line going back, what, nearly 20 years or 20 years or so. Another way I look at the secular trend is to compare the S&P to M2. At the beginning of the cycle, when the Fed is injecting liquidity into the system, that's supposed to positively affect the economy and profits. Now, if that's the case, then stock market participants should be joining in as well and bidding up the S&P at a faster rate than this liquidity is being pumped into the system. Later on, as we move on, the opposite should be occurring, where the money supply is increasing, but stock prices aren't keeping pace with it. And that's what this ratio is. It shows you it moves very closely to the secular movements in the inflation adjusted S&P. But you can also see that from the PPO ratio and the PPO of the ratio in the bottom window, where we divide a 24-month by a 240-month exponential moving average. And you can see these line up nicely with the troughs, not perfectly because we're looking at very long-term trends here. But it's certainly, if you can figure out that the oscillator has started to reverse to the upside or the downside, it certainly gives you some indication of whether we're at a secular peak or a secular trough. And at this point in time, just here, you can see the ratio just started to turn over very, very, very slightly. Now, the other thing here we can look at and use this ratio is to take its 96-month moving average, this one just here, and see periods when the ratio is below its 96-month moving average. That's an 8-year moving average, and it covers several different business cycles, obviously. So these pink shaded areas going in now indicate when the ratio is below its 96-month moving average. Now, there are a few whipsaws that occur along the way, like over here, and there's an upside breakout just there. But by and large, this has been a pretty good ratio for helping to determine the direction of the secular trend. It helped me, for example, back here in 2014, I'd been bearish on a secular trend, and it made me think that I was taking the right position because this indicator had been pretty reliable in the past. Now, there was another whipsaw signal in 2020, but you can see that it broke below this its moving average a couple of months ago or a month ago. So let's just take a closer look at this area in here for the last 18 years, like we did with the Shiller. And here's the ratio breaking out above this green trend line. And again, we have another false upside break. And that break was confirmed by a break below this trend line. And it also, as you can see here, is fairly decisively below its 96-month moving average just here. And the other thing which makes you think it's going lower and therefore going to be signaling a secular bear market is the fact that the KST in the bottom window is just giving us a sell signal. Now, remember, we were talking about commodities being in a secular bull market. Well, this chart here looks at the CRB spot raw industrials, and it compares them to a price oscillator for commodities for this actual index. And the idea is when it crosses above its moving average, that gives us a buy signal. And as you can see, after each of these buy signals, we've had a pretty good rally in commodities. It doesn't mean to say they're going to rally immediately. Right here, for example, you've got the buy signal followed by a small correction or a mini bear market that took place. We may find the same thing in the current situation. So right now we have obviously a secular buy signal because it's crossed its moving average. So what I'm going to do in the next chart is to show you how this relates to the stock market. Thanks, Bruce. Well, if you recall, we were going through this slide here showing the price oscillator in the bottom window. When it crosses its 48-month moving average, which is where we get one of these green arrows, we get a secular buy signal for commodities. But that secular buy signal for commodities also happens to be a secular sell signal for stocks historically. And so what I'm going to do in the next chart is I'm going to use this indicator, this price oscillator, but instead of plotting it this way, I'm going to invert it so it moves more in line with the way that the stock market works, or the stock market moves. So here's that same oscillator. And then instead of the up arrows indicating buy signals to commodities, the down arrows now represent sell signals for stocks. It's not a perfect indicator because none of these secular indicators are, but it has just generated, as we saw before, another sell signal. And you can see specifically the red highlights and the green highlights. The green represent periods when it's above its 48-month moving average, and the red represents when it's below. And the arrows just kind of approximate where you get the actual reversal, which usually comes ahead of the red plot. But you can see it's now officially in bearish territory here. Again, it's not a perfect indicator, but it does isolate most of these trends. The other thing to bear in mind about these secular trends is they can come in two parts. The tops can come in two parts. Either we get a trading range like we had in 1900 and like we had in the mid-1960s and early 1970s, or we get an inverted V, straight up and straight down as we had in 1929, and the same thing 2006 and 2007. So when we talk about a secular bear market, when it's beginning, it could take either of those two forms, and there's really no way of knowing which form it's going to take. So that's why you don't really want to be adamantly bearish when you're in a secular bear market, because you don't know whether it's going to be one of these that starts with a trading range or whether it starts with a straight down. By the way, this is in green right here, which would be kind of bullish in this analysis. But that was 1929 when there was no inflation. It was deflation was the problem. So we have one more secular indicator to look at. This time we're comparing the inflation adjusted S&P with a ratio between the Shiller PE, the return on stocks, versus the return on bonds, which is the 20-year yield. And this, as you can see, follows the secular trends quite well. So when the ratio in the bottom window is moving up, it means stocks are being favored over bonds. And when the ratio is moving down, it means bonds are being favored over stocks. And it kind of like lines up nicely with some of these secular peaks that we've been seeing before. So here we're looking at peaks in the oscillator and peaks in the ratio. Peaks in the ratio compared to the inflation adjusted stocks. It looks very much to me like this ratio is really peaked out for this cycle. But we need some supplementary evidence to prove that, or confirm it, I should say. One would be looking at a downtrend line on the ratio and then seeing when that line is penetrated, and then looking and see what happened to the inflation adjusted stocks. In this case, it was a downtrend penetration. They went to the upside. In this case here, it's a downside break. And that was indicating obviously a secular downtrend in stock prices. If you look to and then we got three more here, another bull market signal, bear market signal, and a bull market signal. So right now we can put another bear market signal in, because it's how we draw that trend line. The price of the ratio is below the trend line. It's also below its 48-month moving average. So that's a decisive signal on a serious trend line break, putting another piece of evidence of a secular bear market into the secular bear market camp, so to speak. What's also interesting is you can redraw the trend line recently, and you can see that we're now at a very important inflection point for this ratio, because it's right at the support level of these two lows here. It's right on this super secular line, because this goes back to 1982. So again, if the secular trend is still an upward one, this is going to represent a great buying opportunity. But most of these longer term indicators are kind of tipping over to the downside and suggesting that that is not the case. So we'll take a quick look at the cyclical trend here with the Pring-Turner stock barometer. This is the composite indicator consisting of 6 different components, trend and components of the market, combined with individual ratios such as the stock bond ratio and the stock commodity ratio and so forth. The red highlights represents periods when it's below 50%, which means it's bearish. And you can see right now it's at a 16% reading, which is not an encouraging reading at all. Another thing you could...
Sorry, Martin. On the
no
Pring-Turner stock barometer, because you publish this in your intermarket review, it's so important, and you publish other barometers. But what I really notice here is that in the secular bear markets, in the big bear markets, it just works exceptionally well. And that in the secular bulls, it'll give you those pauses and those little, brief stops along the way, which are really hard to time, but it does such a magnificent job on the really big secular bear markets. And I just was noticing that.
You must have anticipated what I was going to say, because here's the secular bear markets, and you can see that is the case. And that is right. And during a secular bull market, it really doesn't add any value. It takes value away in some respects, except that it is an insurance policy, because you don't make money by staying out of the market during these sell signals here. One of the things I noticed as I was putting this stuff together, Bruce, was that this current signal is worse. We've lost more money in this current period than we have in any of these other periods since that indicator has been bearish. So you can see this all the way. Sorry, go ahead.
Sort of an early characteristic of what might turn out to be a secular bear. It's a different characteristic than what you see in secular bulls.
That's what I was thinking, but too scared to say.
Well, I said it.
So I just put a few arrows in here to mark these other mini bear markets, and you can see they're all occurring during a secular bull market. So when you're a secular bull market, everybody's a hero because you've got rising tide lifts all boats. But in the secular bear market, these bear markets last for longer, and they're usually 40 to 60%. They cut off the value of in nominal terms from the peak. So I'd like to just quickly wrap up with a few commodity charts. Here's our friend the CRB Spot Raw Industrials again. And underneath is a diffusion indicator. And what that does is it monitors a basket or a universe of commodities and commodity indexes that are above their 24-month moving average. And because that is a jagged series, it smooths it with a 9-month moving average. Bottom line, though, is that when it peaks out, that tends to be bearish for commodity prices. And it's been pretty consistent. How many we got? 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 signals that work. And then I got to show you the ones that don't work. 2 that were not very helpful, false negatives. But generally speaking, it looks like commodity prices are headed lower. One of the other things that's important to note is that the CRB spot raw industrials is now below its 12-month moving average and its 9-month moving average. This is like a 48-month, so it's a much longer term average. But that's another reason why I think we're seeing a cyclical correction in a secular bull market.
So let me ask you a question that probably is unanswerable, and that is, is if the CRB starts to turn down, will that take some of the pressure off of the CPI?
Absolutely, yeah.
Yeah. So that could be put some wind under the sails of the stock market.
Yeah, that's one of the reasons I said at the beginning that I thought that we were going to see that inflation was a long-term problem, but over the short run, we're probably within a short while, maybe a couple of months or so, of seeing a peak in the CPI, and certainly a definite slowing down in momentum, because that's where commodity prices are going.
So just a cyclical correction inside of a secular bull market for commodity prices.
The big trend is up. The less big trend, because the primary trend is still a big trend, is correcting at the present time.
Interesting.
So one key commodity, Dr. Copper, is shown on this chart here, together with my special K indicator. You can read about this at pring.com or on the in chart StockCharts in the chart school. Basically speaking, the special K is constructed by adding up a short term, an intermediate term, and a primary trend momentum indicator into one indicator. And what it does is it tries to pinpoint the peaks and troughs of the cyclical or primary trend peaks and troughs by peaking itself or troughing itself. And you can see that's been the case here, where there's a peak, that was a peak, there was a cyclical low, there was a cyclical low, there was a high, there was a high, there was another low. So that's the theory of it. The question is, how do you determine when the thing is reversed? Because you obviously can do it easily with the benefit of hindsight, just getting your mouse and pointing to a peak and pointing to another peak. But how do you do it in real time? Well, one way in which you can do it is to take the signal line, although that from time to time is a little whipsawy, like it was in this period here. Most of the time it's not, but it does have problems. Another thing you can do is to draw trend lines. And when those trend lines are confirmed by trend lines in the price itself, and this is not just for copper, this is for any financial market that you might have or be interested in analyzing. So looking at copper right now, you can see that it has broken down from a top, and the special K has also completed a top. And that's pretty decisive. Obviously, copper is pretty oversold right now, and it's certainly due for a bounce, but the basic trend seems to be a downward one, which is consistent with what the diffusion indicator in the previous chart is telling you. So finally, we'll take a look at oil, West Texas Sour, because I have a big history on that, and our favorite oscillator, the 60 by 360. And we can draw in some lines here which indicate buy signals. You can see in each case, if you look to the right of the tip of the arrow, you don't necessarily get an immediate takeoff, but it does indicate that the main trend is long. So it is up. So just because we have a sell signal on a lot of our primary trend indicators of commodity prices doesn't mean that's inconsistent with the secular trend also being up. So when we look at this chart here, you can look at a very, very long-term trend line here. Remember, I was telling you earlier about the whipsaw signals being followed by above average moves. Well, there's a great example of how this whipsaw signal here in West Texas sour was followed by a very, very sharp move to the upside. We still don't know whether we're at the top of that move, but we have enough information to suggest that oil is in a secular bull market, because we not only have the oscillator signal, buy signal, but we've also broken above this trend line. That trend line doesn't look very long, but it goes back to 2009. That's 13 years. That's a pretty long trend line. And also the oil price is above its moving average. I believe this is a 96-month moving average. But by the same token, it has reached resistance in the form of its previous highs just here. So I wouldn't be at all surprised if the recent correction extends a little bit and takes the price down towards its moving average in the 60 area. That's quite a drop from 108, but it'll be enough to change people's view of where oil is likely to go and provide a great buying opportunity for that particular commodity.
And that could take months to a year or two to, I mean, that's the perspective that your charts offer us.
Yeah, that's absolutely right. And it will be a correction, a cyclical correction in an ongoing secular bull market. So it's probably going to be a short and sharp one, just like we had the short and sharp stock market corrections. This could be a short and sharp one as well. So Bruce, that wraps up what I have to say. I don't know if you have any more observations, because they're pretty good observations so far.
Well, Martin, thank you so much. And I don't want to make you blush, but you are a treasure, and we are so grateful for you, your remarkable perspective of the longer term timeframes, and the ability to be able to pull it all together for us. And so we really do appreciate you and all the great work that you do. And there's many ways to keep up on Martin's research. You can do it at StockCharts.com, where he does a wonderful blog. You can go to Pring.com. He has lots of great material at Pring.com, and also his remarkable intermarket review, which, Martin, how long have you been publishing that?
1984.
Oh my. So it's a remarkable
under different names, but
yeah, same material. So
well, thank you very much, Bruce. You'll certainly get that $5 we talked about earlier.
Well, thank you, Martin. We all thank you, and everyone, we appreciate you being here, and we will see you again next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.